On September 15, 2008, the world woke up to a different reality. You remember the footage. Employees walking out of a glass skyscraper in New York carrying cardboard boxes filled with their personal belongings. That building was the headquarters of Lehman Brothers, a bank that had survived the Civil War and the Great Depression, but couldn't survive its own greed. In the weeks that followed, the global economy suffered a heart attack. The stock market crashed, trillions of dollars in wealth evaporated, millions lost their jobs and homes. But while you were panicking and while families were being evicted, something strange happened on Wall Street. The same bankers who had set the fire were handing themselves parachutes made of gold. They didn't go to jail, they went to the Hamptons, and the bill for the damage? That was sent to you. We are told that the 2008 financial crisis was a complex event. We are told it was a perfect storm that nobody could have predicted. That is a lie. It wasn't a storm. It was a heist. It was a mathematically calculated gamble where the banks played with your money, and when they lost, they forced you to pay the debt. So how did they do it? How did they turn the boring, stable housing market into a global casino rigged to explode? To understand the crime, we have to go back to a time when banking was boring. Picture the year 1970. If you wanted to buy a house, you walked into your local bank. You sat down with a banker who knew your name. You showed him your pay stubs. If you had a good job and a down payment, he gave you a loan. The bank kept that loan in their vault. If you paid your mortgage every month, the bank made money. If you stopped paying, the bank lost money. This was a simple, honest system. The bank cared if you could pay them back because it was their money on the line. But then Wall Street got involved, and Wall Street hates slow and steady. They invented a new financial product called the mortgage-backed security. Here is how it works. Instead of the local bank keeping your loan, they sold it to a big investment bank on Wall Street. The investment bank would take thousands of these loans and put them all into a giant box. Then they would sell shares of that box to investors. Suddenly, the local bank didn't care if you paid your mortgage. They had already sold your loan. Their only incentive was to sell more loans as fast as possible. The connection between the lender and the borrower was broken. For a while, this system worked because the loans were prime. They were given to people with high credit scores and steady jobs. But the bankers had a problem. They were making so much money selling these securities that they ran out of prime people. There were only so many people with perfect credit scores who want to buy a house. The supply of good borrowers dried up, but the demand for greedy investors was insatiable. So the banks had a choice. They could stop making money, or they could lower their standards. They chose the money. They started giving loans to the subprime borrower. These were people with low credit scores, unstable incomes, or a history of not paying their bills. In the industry, they called these ninja loans. No income, no job, no assets. Imagine a strawberry picker in California who makes $14,000 a year being given a loan to buy a $700,000 house. It sounds insane, but it happened. Why would a bank lend nearly $1 million to someone who clearly couldn't pay it back? Because the bank wasn't going to keep the loan. They were going to wrap it in a box and sell it to a pension fund in Norway 5 minutes later. It was a game of hot potato. As long as they could pass the risk to someone else, they didn't care. But the big investors on Wall Street aren't stupid. They knew that a box filled with loans to unemployed people was risky. They wouldn't buy it if they knew it was toxic waste. So the banks had to disguise the toxic waste. They had to make garbage look like gold. They did this using a weapon of mass financial destruction called the CDO, the collateralized debt obligation. Imagine you have a box of old rotting fish. Nobody wants to buy it. Now, imagine you take that rotting fish and you mix it with a few pieces of fresh steak. You grind it all up into a stew. Then you pour that stew into 3 different bowls. The first bowl you call the senior tranche. You tell investors, this bowl gets paid first. It's the safest. The second bowl you call the mezzanine tranche. The third bowl you call the equity tranche. But here is the trick. It's all the same stew. It still contains the rotting fish. The banks took thousands of these terrible subprime loans and bundled them into these complex CDOs. They used complicated math to convince the world that by mixing a bunch of bad loans together, they had somehow created a safe investment. It defies logic. If you take a pile of dog manure and mix it with another pile of dog manure, you don't get a pile of gold. You just get a giant pile of manure. But they needed one more accomplice to pull off the heist: the rating agencies. Companies like Standard & Poor's and Moody's are supposed to be the referees. They look at an investment and grade it. AAA is the best, B or C is junk. When the banks brought these CDOs filled with toxic loans to the rating agencies, the agencies didn't stamp them as junk, they stamped them AAA. Why? Because the banks paid the rating agencies. If Moody's refused to give a AAA rating, the bank would just go down the street to Standard & Poor's. The referees were on the payroll of the players. So now you had pension funds and insurance companies buying these CDOs thinking they were buying safe assets. In reality, they were buying time bombs. From 2004 to 2007, the bubble inflated. Housing prices skyrocketed. People started treating their homes like ATMs. Everyone believed the lie: real estate prices never go down. But math ultimately always wins. Most of these subprime loans had adjustable rates. The borrowers were given a low teaser rate for the first 2 years, but after that, the rate would explode. In 2007, the teaser rates started to expire. Suddenly, the strawberry picker who was paying $2,000 a month had to pay $4,000. He couldn't do it. He defaulted. And he wasn't the only one. Millions of homeowners began to default at the exact same time. The stream of money flowing into the boxes stopped. The investors holding the CDOs realized the box wasn't full of gold, it was full of worthless paper. Panic set in. The big investment banks, Bear Stearns, Lehman Brothers, had borrowed massive amounts of money to buy these CDOs for themselves. They were leveraged 30 to 1. That means for every $1 of their own money, they gambled $30 of borrowed money. When the value of the CDOs dropped by just 3%, these banks were technically bankrupt. On March 14, 2008, Bear Stearns collapsed. On September 15, 2008, Lehman Brothers collapsed. The dominoes were falling. The global economy was staring into the abyss, and this is where the final betrayal happened. The banks went to the government, to the taxpayers, and said, "If we die, the world dies with us. You have to save us." They called it too big to fail. The U.S. government passed TARP. They took $700 billion of taxpayer money and injected it into the very banks that caused the crisis. They bailed out the arsonists. But they didn't bail out the homeowners. Millions of families were foreclosed upon. They were kicked out of their homes. Their credit scores were ruined. Their retirement savings were decimated. The bankers? They used the bailout money to pay themselves bonuses. In 2008, the same year the economy collapsed, Wall Street firms paid out $18.4 billion in bonuses. They privatized the gains and socialized the losses. When they won, they kept the money. When they lost, you paid the bill. This event fundamentally changed the psychology of a generation. We realized that the system is not designed to protect us. It is designed to extract from us. But why does this matter today? Because the underlying problems were never fixed. The banks are bigger today than they were in 2008. The leverage is still there. The complexity is still there. They just changed the names. Instead of CDOs, maybe now it's opaque derivatives or risks hidden in the shadow banking system. And the moral hazard is worse than ever. The banks now know for a fact that if they gamble and lose, the government will print money to save them. They have no reason to be careful. So what is the lesson for the finance-conscious individual? You cannot blindly trust the authority. You cannot trust the rating on the bond, the suit on the banker, or the assurance of the politician. In 2008, the smartest men in the room, the PhDs, the CEOs, the Federal Reserve Chairman, all said everything was fine right until the roof caved in. The only people who survived and profited were the big short guys, the outsiders who actually read the footnotes. They realized that just because the crowd is running in one direction, it doesn't mean they're right. Sometimes the crowd is just running off a cliff. We are living in a fragile system. If the confidence breaks again, the 2008 playbook will return. They will print money, they will bail out the rich, and they will inflate away the value of your savings to pay for their mistakes. The only defense is education. The only defense is owning assets they cannot print. The only defense is understanding the game so you don't become the victim of the next hand they deal. The 2008 crisis wasn't an accident. It was a crime scene, and the suspects are still running the bank. If you want to stay awake while the rest of the world sleeps, and if you want to understand the mechanics of the machine that controls your money, make sure you are subscribed to the channel. We don't just read the headlines here, we follow the money. Thanks for watching. I'll see you in the next one.